Well, the spread of the coronavirus has taken its toll on markets around the world. Trillions of pounds has been wiped off the value of shares in recent days. Oil prices are down by around a third. That's the biggest fall in almost 30 years. Well, our business presenter Ian King joins us live from the city. Ian King, what is happening on the markets?
Hello, Adam. Yes, I join you from the trading floor at Peel Hunt City Stockbrokers, where the FTSE 100 opened an hour ago. The FTSE has fallen very, very sharply by 8% at one point, and the FTSE, I can tell you, is now officially in bear market territory, having fallen by more than 20% since its most recent peak in February. Now, the real driver for all this, Adam, is the oil price. That's been behind this latest lurch downwards. On Friday afternoon, the Saudi Arabians and their allies in OPEC failed to reach production cut agreement with Russia. They've been looking for the Russians to trim their output by around 500,000 barrels a day. The Russians said they weren't going to play ball. The reason for that production cut was that they wanted to bring supplies into balance with demand, which has obviously fallen off post the coronavirus outbreak. The Russians, as I say, wouldn't play ball. So over the weekend, the Saudis have effectively declared a trade war on the Russians. They've said that they're going to up production. As a result, you've seen this really historic fall in oil prices. Crude dropping by 30% over the weekend, $11 a barrel or so in Brent crude. I mean, that is the biggest one-day fall since the first Gulf War back in 1991. The word crash is often overused, but I don't think it's an over-exaggeration on this particular occasion to say that the price of oil has absolutely crashed. Now, that particularly hurts the FTSE 100 because it's very heavy in resources stocks, the likes of Royal Dutch Shell and BP, respectively, the first and fifth biggest companies on the FTSE 100. Well, both of those came off by more than 20% at the open. They've stabilised during the last hour or so, but both of those stocks, very, very important bellwethers, held by millions of shareholders around the world, by almost every index tracker fund. Well, those have fallen, but they're around about 17 to 18% lower right now. Now, the other really dramatic news that I have to bring you, Adam, is what's been going on in the gilt market. Now, you've obviously seen a big dash towards sovereign debt bonds in recent days, and that has depressed the yield. The yield falls when the price rises, and you saw on Friday afternoon, for example, on Wall Street, US Treasuries, really, the yield on those really dropping. Overnight, you've seen the yield on 30-year US Treasuries, the long bond, which is a very key financial instrument, that's gone below 1% for the first time ever. This morning, more dramatically than that for the UK government bonds, gilts, you've seen the yield on 2-year gilts go negative for the first time ever. In other words, borrowers are actually paying the UK government for the right to lend money to it. Now, this is something we've seen in the Eurozone over the years, for example, with German government bonds. You've seen those trading on negative yields. This has never happened with the UK before. So a very, very dramatic moment. All sorts of implications, Adam, for government borrowing, given that Rishi Sunak, the new Chancellor, is being urged in some quarters to increase government borrowing, turn on the spending taps, and the gilt market essentially, certainly on the 2-year level, is giving him every opportunity to do so. But I mean, the broad picture, Adam, is it's absolute carnage. You're seeing, as I say, big drops in some of the oil prices. The likes of International Airlines Group, the owner of British Airways, that's been smacked by another 8% today as well. So really ugly picture right across the piece.
And the irony, Ian King, is that normally a low oil price and low interest rates would be a stimulus for industry.
Yes, that's absolutely right, Adam. Normally, a higher oil price is seen as a tax on growth, but in this particular instance you've got a fairly toxic combination because the oil price has got two factors depressing it. One is lower demand as a result of coronavirus, and the other is higher supply with the Saudis turning on the spending taps. This is going to have all sorts of knock-on effects everywhere, Adam. You're going to see, for example, I think some of the big US shale producers, they're going to come under pressure. A lot of those have issued a lot of debt in the junk bond market. You're going to see that coming under pressure, so the knock-on effect will be right across all sorts of financial asset classes. But to your point, it's very interesting actually in this regard to look at what happened in Japan overnight. Now, the Nikkei, the main Japanese stock index, fell by some some 5%. Japan is a very, very big oil consumer, a big oil importer. Other things being equal, you would assume that this would be very good for the Japanese economy, potentially offer some stimulus. What seems to have happened is that there's been a rush into the Japanese yen. Now, the yen is obviously seen as a bit of a safe haven at times like this. A higher yen means that it's more expensive for Japanese exporters to export their goods, and accordingly, that's why you've seen the Nikkei selling off. You're seeing all sorts of asset classes coming under some very unusual pricing movements indeed.